In today's video, we're going to get to the bottom of the great debate of index funds versus stocks and which one is better for your portfolio. I think we can all agree that the main goal of any investor is to make money. You want to make sure your investments grow over time, eventually affording you a life of control or amazing wealth. But how we make that money might be different depending on each of our goals. So let's start off by identifying what our goal is. Number one, do you want to beat the stock market average and make a ton of money? Do you want to be the next Warren Buffett? Number two, do you want to be someone who can achieve financial independence, take a consistent route, and minimize the risk of stock market decline or crashes? Now on this channel, we tend to lean toward that number two, but I'm going to address both goals related to index funds versus stocks in this video. So before I show you some incredible information, let's talk about the difference between an index fund and a stock in the first place. Let's start with stocks. A stock is an individual company. So when you buy shares of a particular stock, you're buying and ultimately betting on the performance of that singular company. Think about your favorite brand or company that you interact with today. Maybe it's iPhone, maybe it's Apple, maybe it's Delta Airlines. Whatever the company might be, if it is a public company, that means you and I can buy shares of that company. Then as the valuation of that company grows over time and investors value that company and they perform well, we'll get rewarded with stock market growth, as well as any dividends that company may pay in the future. Now, of course, if the company doesn't do well, we have to go down with the ship. But the goal is for that individual stock to go up, and we can own as many individual stocks as we want to. We just got to make sure we pick the right ones. Now, an index fund, on the other hand, is a collection of hundreds or thousands of stocks that are usually weighted by market cap. Let's take the S&P 500 index fund as a quick example. Now, the S&P 500 index fund tracks the top 500 companies in America based on market cap. Popular index funds for the S&P 500 that you can invest in include the ticker symbols SPY and VOO. So when you buy an index fund, you're ultimately aiming for steady growth based on the trust and faith of the growth of those companies that the index fund invests in. Now, beyond the S&P 500, there are plenty of other index funds that you can put your money into. So for example, you could get an index fund that's based purely on technology, or the total stock market, or real estate, healthcare, commodities, the list goes on and on. But here's where things get a little bit interesting when it comes down to index funds versus individual stocks. And that is the difference between performance and steady growth. Now, if you buy into the index fund of the S&P 500, when a company grows and when a company fails, the S&P 500 index fund automatically updates its holdings. You don't have to do anything. You sit back, relax, and you keep on investing in your favorite index fund. That's all you have to do. But when you buy a single stock, if that company grows like crazy, you're going to be happy, of course. You're going to be hopefully a millionaire, and you'll want to make sure you cash out at the appropriate time. But on the other hand, if that single stock crashes to the ground, as I mentioned earlier, you get to sink with the ship. Let's say you bought a single stock like Circuit City. That isn't around anymore. Or let's say you owned shares of stock of Lehman Brothers. Not around anymore. Now, if that's scary to you, that could be a big telltale sign that you're more interested in taking a more passive route of index funds versus the more risky route of individual stocks. Or maybe you want a little bit of both. It's totally your call. But instead of just talking about the scary things, let's talk about the exciting things. What if you invested $10,000 back in 1985 into Apple stock? Did you know if you would have done that today in 2024, that $10,000 is now worth, as long as you didn't touch it, $24,270,157. Amazing. High risk, high reward. But let's take an example of how powerful index funds can be if you take them as a method to achieve financial independence, and how owning single stocks could actually bite you in the long term. This website is absolutely epic because what it does is it shows you the top 20 S&P 500 companies rated by market cap all throughout all these years. You can just click through and it'll automatically tell you what those top companies were. And ultimately, that's what the index fund of the S&P 500 is going to invest in. And whatever is at the top or the highest market cap, it's going to put the greater percentage into that company. So here, for example, in the year 2001, most of your money when you invest in an S&P 500 index fund would have went into General Electric, followed by ExxonMobil, and so on. So remember how I said it would automatically adjust its holdings and you don't have to do anything? So if we look here in 2024, you can see Apple and Microsoft lead the way. Look at that, significantly, followed up by Alphabet, which is Google, and Amazon. If we go back to 1990, it's a whole different picture. We're talking about ExxonMobil, IBM, Lowe's. In fact, I don't even see Apple on this top 20 list. So if you would have held all the way through, your index fund would have automatically updated the holdings and enjoyed the growth through this entire period of time. Because if you look here, that total market cap at $511,000 has grown to a remarkable $17,685,000. So you're enjoying the growth while you don't have to worry about one or any of these companies succeeding or failing. It doesn't matter. So instead of finding the needle in the haystack, like the example of buying $10,000 of Apple in 1985, we're just going to buy the entire haystack. That's the point. But things get interesting when we do some basic calculations. So buckle up, my friends. We're going on a money ride. So let's take a look as an example in 2001. So let's say you had two different people, okay? And one person is going to invest in, let's say, the top 2 companies of the S&P 500. The other person is just going to invest in the index fund of the S&P 500. So because these two are the most talked about, GE and ExxonMobil, most people are going to say, man, that's the top company, that's the big dog, that's the one you want to go for. And everybody's going to rush in and buy those 2 stocks. Meanwhile, we're just going to buy the whole haystack. So if I go over to the portfolio visualizer, I'll link all this down below so you can try it out for yourself. Year is 2001. We're going to drop $10,000. So one friend is going to drop $10,000 into General Electric, and that'll be portfolio number 1. The next friend is going to go all in on ExxonMobil, and they're going to use portfolio 2. And then the third one is going to invest in SPY. That is the index fund indicating the S&P 500. They're buying the whole state. They're buying the whole haystack in that particular case on portfolio number 3. Now, check out what happens to your $10,000 between 2001 and 2024. Portfolio 1, that indicates General Electric, has grown your $10,000 down. It's lost money. You now have $8,301. Ouch. That's where you're going to say the stock market is a scam. ExxonMobil, well, it did okay. Your $10,000 is actually worth $49,000. That's pretty darn sweet. If you would have bought the entire index fund, though, your $10,000 is worth $56,000. We see who the clear winner is. And check out this awesome graph through that entire period of time. So if you look here, I mean, there's going to be periods of time where one's going to outperform the other. There's going to be a single stock that outperforms the S&P 500. It's just going to happen. So like, it's really kind of cool because, you know, GE was kicking butt and then it failed. That's the blue line. But even down here, you can see that the S&P 500 indicated by that orange line starts really outperforming ExxonMobil, but then ExxonMobil comes back with a vengeance. Right here, ExxonMobil is actually above the S&P 500, but then it flips around. So that's the big thing that you need to think about is, oh, geez, even though today, if we come over here and look at 2024, Apple and Microsoft are leading the way, but can we be certain that they're going to lead the way 30 years from now? We don't know that. Maybe, maybe not. There could be 2 other companies up here. There could be another 4 companies up here that are leading the way. Something that we haven't discovered yet. Maybe it'll be artificial intelligence or something else that we don't even know exists yet. That's the beauty, because I bet back here in the year 2001, yeah, we knew about technology, but we didn't know that Apple Computers was someday going to be one of our top dog companies. We didn't know that. We thought General Electric was where it was at. That's a big difference. And I don't know about you, but man, if that person invested in General Electric, today they're just hurting. Unless they pull down at the perfect time, but we never do. So here's what I'd recommend you do. Go through this website, link down below, click through all the years, and play around with it. All you have to do is click on a year, see what the top stocks were, plug it in here to the portfolio visualizer. You can simulate whatever you want. Maybe you invest every single month and not just drop $10,000 right away. Maybe you don't. Play around with this and see, does it make more sense for me to go in on a single stock or onto the entire haystack? There's going to be some scenarios where it would make sense to buy a single stock, but then there'd be better scenarios like the one we just shared where it makes sense to own the entire index. But again, if you're somebody that is stressed about, yeah, but what, it would be really cool if I had Apple because then I'd have all that money, but then what if it doesn't? And you're having that debate in your mind, that's where you need to pause and say, does it make sense to take the easier route of the index fund? I hope this video helped explain the difference between the two of them, but if you have any other questions, drop them down below. And for more about financial independence, you got to check out this video next, and we'll see you on the next video.